to scale past that level of 21,700. The heavy lifting today has of course been done by Reliance. That stock is sitting at a record high level right now, managed to surge past the market capitalization of 20 lakh crore rupees, and of course it's the most highly valued company if you go by the market capitalization, so that definitely aiding the sentiment for the bulls. Separately, you also have ICICI Bank that is fairly charged up. In fact, in the last few minutes we have seen an up move in ICICI Bank, holding with a gain of around 2%. Axis Bank, Coal India, L&T are some of the other heavyweights from the frontline index which are batting for the bulls. On the losing side, however, it's clearly Hindalco which is reeling under pressure as we speak. There's no buying on dips happening there. It's a cut of almost 14% on Hindalco, and the cut on Paytm also continues. There was a big downgrade that came back from Macquarie. They have slashed the target price all the way to 275, so that pressure continues. And again, no bottom fishing on Paytm today. That is under pressure. Grasim is down 4%, and M&M 2 ahead of its earnings is going a bit weak. There's a cut of 1.5% as far as M&M is concerned, and Aisha is the other one that we are watching out for ahead of its earnings, which are expected later today. That's the market mood right now, but what about the fundamentals of the market? That's something we'll try and decode with Siddhart Vora. He's a fund manager and head of investment strategy at Prabhudas, Liladher. Hi Siddhart, good to be speaking with you. That's exactly the first question on the market. Do you think this consolidation, this sideways move, this boring kind of market is likely to continue at least for the interim given the lack of the triggers?
I think we are at a very interesting stage in the market cycle. When we look at, say, the valuations at Nifty levels, I think we're still significantly, 15 to 20% below the long-term averages, which is causing some pain in the markets. As per our proprietary valuation indicators, we take a very quantitative approach to, researching and managing money. So based on our quantitative indicators, more than 70% of all the stocks in the mid and small cap segment in India are trading at least one standard deviation above their historical multiples. So I think that is a cause of concern. Coupled with all the euphoria that we've seen in the rally that is built up so far, I think some correction, some consolidation, and much higher volatility can be expected in the mid and small cap space. But given that, I definitely still maintain a very, very positive bias towards equities globally and in India as well. Globally, it's supported mostly by the risk-on indicators, whether we look at credit spreads, which are sub-4 levels, or we look at how inflation is cooling off globally. I think the soft landing has definitely happened, and US is also in a fairly resilient shape. And India, I think nobody needs to discuss more on why the next 5 to 7 years belong to India, how we become the third largest economy by 2028.
Sure.
So I think positive bias for sure.
Sure, positive bias for sure, and clearly it seems to be tilting a lot more towards large cap given the volatility you're expecting on mid cap and small cap. But within large cap, Siddhart, I see that you're tilting towards autos and financials as the spaces that you like. And both of them are a bit confusing for me, given the fact, of course, autos have seen a massive run up last year, and people are now talking about tapering their positions because the valuation there has become too punchy. And on the financials, it's the exact opposite. People are expecting this underperformance to be a bit more protracted. What then makes you positive on these two sectors?
So in our portfolios, the heavyweight sectors that we take a very benchmark agnostic weighting method. So we focus on 4 key sectors here: financials, industrials, energy, and auto. But if I look at my financials, industrials, and energy weight, all of them are more than 25%, which is significantly higher than the benchmark allocations. And the differentiated pick here is that within financials, it's not that we're focused on private banks alone. So let's not confuse financials with the likes of, say, HDFC Bank or Kotak Bank or Bajaj Finance. We have taken a very differentiated approach even to our financial allocation. We've been more prone PSU banks, PSU NBFCs, the PFC and RECs, and some of the more capital market oriented plays, whether you talk about brokers, exchanges, or any capital market intermediaries. So our financials position, while large, has been differentiated from a traditional financial allocation. Similar, while valuations could be stretched somewhere, I think the growth levers are strong enough for these to continue doing well for the medium to long term.
But for PSUs, are you not looking at trimming positions at all? Because as you pointed out, they are moving much above their trend lines.
So over the last 8 months, we've had a very, say, 28 to 42% allocations across the PSU pack, not necessarily the IRFCs or the SGBNs of the market, but more of the PFCs, the RECs, the BPCL, IOCL, the whole energy pack of PSU, Coal India, HPCL, etc. So we're happy holding some of our positions while moving out into more large cap defensive positions. So we should be able to reduce from, say, 42% to more like 24% over the next couple of weeks.
So you are pruning your positions and reallocating a bit as far as some of the PSUs are concerned. That's good to get the clarity on. But shifting focus to what's happening in the markets and overall the private banking space as well. Just wanted to scratch that point further with you, Siddhart. You said don't confuse it with the likes of HDFC Bank. But people who are holding it or people who are looking to enter, do you think this makes it a good time to look at some of these private banking names, at least for the medium term?
So the way I'll answer it the way we manage money, which is very different from what a traditional fund would look at. So over the last 8 months, we've not had a single percentage of allocation to Kotak Bank, to Bajaj Finance, to HDFC Bank at all. The way we do it is we run a 25 stock portfolio, which evaluates all the listed securities based on their fundamentals, their valuation, the risk, the technicals, the sector strength, and the style alignment given the current market regime. And unfortunately, we have been in a value momentum orientation in the market. And in that regime, an HDFC or Kotak would never fit in. So till we don't move out of a value momentum regime and move to, say, a quality oriented regime, I don't think owning an HDFC bank would add any significant alpha to my fund. So for those reasons, we stay out of these. And even as of now, we would continue to stay out of the likes of HDFC Bank or Kotak Bank till their overall scores don't start improving.
Okay, that's good to get that clarity, and clearly that strategy has been working out well for you for now, whether it's PSUs, whether it's staying away from private banks, as well as energies and industrial is doing well. Thanks so much, Siddhart, for making time and speaking with us. Good to get